Hello, I'm Ross Bird, Equity Strategist for Aegis Equities Research. With me I have Peter Ray, stock picker for the Aegis Alpha Power portfolio. Peter, the portfolio also includes defensive stocks such as Woolworths, Wesfarmers and Goodman Fielder. How do you see the outlook for these stocks in the current market environment?
Yes, look, even though consumer spending may turn down in the current environment with oil prices remaining high, interest rates high, we think that stocks such as Woolies and Wesfarmers, which owns the Coles business, and Bunnings stores, will fare reasonably well, definitely much better than discretionary retailers with their basic supermarket offerings. Look, there may be some slight downturn in spending in supermarkets, but overall we think that their businesses are reasonably defensive in such an environment. Woolworths, if you look at Woolworths has got very strong management. Over a long period of time they've managed to grow earnings quite strongly, particularly through measures to improve their supply chain, continue to lower their costs. Our forecasts for Woolworths are for double-digit growth in earnings per share to continue at least over the next couple of years. We think they're going to continue to do that for some time. Wesfarmers, as you know, has recently acquired the Coles group of businesses. Wesfarmers is another company that has a good track record of delivering over time. Strong management, strong disciplines in terms of their capital management, the way they run their businesses. Whilst there are some challenges for them in integrating the Coles business, because the Coles business was an underperformer under the previous management, we think that they have the skills to be able to do that. There's probably no quick fix, no easy runs for them to get, but we have confidence that in the medium term that they will be able to turn that business around and achieve some fairly good benefits for their shareholders. In addition, Wesfarmers has an energy business. They own coal mines in Queensland. They have the Curragh coal mine in Queensland. They recently announced that the prices that they receive for their coal had, I think, just about tripled from around the $100 mark to $300. So earnings in 2008 and 2009 will benefit from that strong demand for coal and the significant increase in coal prices. And that will see earnings growth escalate over the next couple of years, and that will tide them over until some of the benefits of the Coles acquisition start to appear, say, in 2-3 years' time.
And Peter, what about Westfield? Westfield has a large presence in the shopping industry, both in Australia and also in America and the UK. How are they going to fare in those different economies, given we have a slightly negative view of the American economy and also the UK showing some weakness as well?
Well, Ross, we see Westfield as being the premier shopping centre operator listed on the Australian Stock Exchange and one of the leading shopping centre operators globally. The shopping malls that they own in America and the shopping centres here in Australia are prime, high-quality shopping centres. Recently, Westfield released figures for the March quarter and was showing that sales in their centres were holding up quite well despite perhaps a shaky environment in the US. Importantly, a large part of Westfield's revenue is derived from base rents which aren't really linked to turnover or to sales. So if sales in the stores fall, it doesn't really have an impact on the rental income that Westfield receives. So we think that they're well placed. We see them as being relatively defensive. If you have a look at how the share price has performed over the last few months, it's been relatively stable in a market that has been quite volatile and declining over recent weeks. So given the strength of the portfolio of assets that they own, we think they're well placed in this environment. The Westfield management has a good track record as well. They manage the portfolio of shopping centres that they own. They divest centres that they think are not going to perform well and acquire new centres that they think will perform very well. They have a strong development pipeline. They're constantly upgrading and developing the centres that they own to ensure that the revenue continues to grow in those centres. So Ross, I feel quite comfortable with the stock, and particularly the management and the way they run that business in the current environment.